watching Stockwatch. I'm Simon Brown. Joining me to unpack your stock-related questions today, Gary Booysen from Rand Swiss, Nader from Benguela Global Fund Managers. Be sure to send your questions through email, stockwatch@bdtv.co.za, SMS 41392, or on Twitter @BusinessDayTV using hashtag Stockwatch. Gentlemen, thank you for your time. I suspect, Grant, let's start with you. Let's start with the Trump tariffs. The world is hating on it, but I mean, markets are falling. How are you guys, Miguel? I mean, what's your strategy here? Are you ignoring it? Are you worried that this is a Smoot-Hawley from 1930, which led to depressions? What's your take here?
Simon, I mean, look, there's a lot of news flow, and I think one has to be so careful about reactive trading or investing. So, and I think we literally in Act 1 of 3. So to make decisive changes to a portfolio, the tariffs are out. Everyone's panicked because they're worse than what was expected, and that's fair enough. But what we don't know yet is what people come back with and counteract. So the big economies like China, Europe, they can come back with something. And then we also don't know if there's a negotiation that takes place and where tariffs actually end up. So 6 months from now, are we still at 30%, or have we gone to the table and we're down at 15 or 10? So yeah, be careful of being reactive, be careful of making major decisions based on what is still unclear in terms of how things unfold. And I have a high degree of confidence that the tariff landscape will look very different a year from now than it looks today as we wake up.
It's a fair point. Gary, do you concur? Because I mean, my corollary to that would be agreed, and my investment time horizon is many years, if not decades, and this might be a difficult period, but it's just a short-term period, which might even last a couple of years, but it too shall pass.
Yeah, I think I do agree. I think you also need to look at like how market pricing has reacted already. So yeah, I get the sense. I mean, we were chatting to clients, beginning of the year, and we had kind of the Trump administration coming in. We'd had the election. There's all this optimism around, regulatory barriers were going to be reduced, and this is the most market-friendly thing possible. And you just had this like incredible sense of optimism, and you had markets, at that stage looking pretty expensive. And at that stage we were starting to skew more towards value because it just seemed like there was too much in the price. Now you get the sense that, as Grant says, it's the uncertainty you can understand. I mean, we just don't know how this is going to respond, and you can look at all historical periods where tariffs have been implemented, but that's not to say that it's going to work the same way this time around, because we don't know how much of this is negotiation and bargaining. We don't know, what the retaliatory measures from other countries are going to be. And also, it's very different because the objective of this is, yes, to move manufacturing to the US, but it is also to try and, almost level the playing field for the US, which generally does face punitive tariffs. So the big risk for me around tariffs long term, which is what you're talking about, your long term look at the portfolio, is how much is this going to skew the output of different countries, and how much of it is going to determine nonsensical investment decisions being made. And I think that might be less than the future. This is very different from a country that says, well, I want to protect our wheat industry. Let's hike tariffs on wheat, and then create an inefficient wheat industry within its own borders. This is actually leveling. It's actually flattening the playing field, which I think might have surprising results. Now, every economic theory and economic textbook tells you, tariffs are bad. It's going to create barriers to global trade. It's going to reduce I suppose, global output, and you're going to potentially send, the US into recession. I think Goldman Sachs put their forecast at a US recession this year at about 35%. But longer term, if it doesn't create this kind of zombie industries, this could actually be potentially good, and especially good if we do see this as almost the first shot, but the US also saying, yes, it's a way to raise revenue. But if other countries do, reduce their tariff barriers, then the US will reduce theirs. So there's just so many moving parts to it. So I absolutely agree with Grant. These fast reactions, I think, are probably unwise. Rejigging your portfolio just because we've had an announcement last night, not a good idea. But at the same time, you have to be cognizant that share prices are moving. It looks like we're going to have the S&P 500 down 3% tonight. You've had huge sell-offs in some of in certain counters, and that generally does present opportunity. And when those opportunities become deep enough, I think probably worth having a look at.
Yeah, I take your point. I mean, crisis and opportunity. So we were talking tariffs. The other side of the coin was VAT. Gary, let's stay with you. The story is perhaps less that we got the 0.5% VAT increase, more maybe that the market is worried about the Government of National Unity holding, and we see that in the rand. I mean, the dollar index is markedly weaker today, yet our currency is also weaker. We've got our own internal skittishes, which is not helping our market.
Yeah, and you can see it. Yeah, as you say, dollar index down around 2. Dollar index now trading just under 102, so down around 2% after the Trump announcement. But the local currency down a lot more than that, and we can feel the sensitivity to the currency to even leading up into the vote. On Friday when we saw that the ANC had walked away and had ceased negotiations with the DA, we had the currency weaken almost 20 cents just on that announcement. Then it was kind of released that everyone was talking again, and we saw the currency reverse on Monday morning. So obviously very, very sensitive, as you say, to the GNU holding together. And I mean, I suppose it's the kind of headlines that we've seen around, if you didn't vote for, the VAT increase and for this budget, how can you be part of implementing it? It just shows how difficult it is to operate a coalition government. And I think, while we've been doing pretty well up until this point, this was the big test. And at the moment, again, we don't know what's going to happen next, but we hope the GNU holds together. But if it doesn't, that's a very market unfriendly outcome, and we can expect the currency to weaken. And you can see it, today specifically in our banking index. I mean, the financial index down over 5%, and that's partly currency, but it's partly also just concerns around positive growth expectations from a sensible market friendly government.
And I mean, Grant, with that in mind, I mean, to your earlier point, which is the don't panic, and I agree with that. Don't suddenly start rejigging your portfolio. But it is sort of double hard being a South African investor right now with, the GNU on the cusp and the tariffs flying around.
Yeah, it's hard to separate what's getting hit from what. Everything's down. And I think that's actually a great opportunity if you're careful. But it's not clear what's down because of tariffs and what's down because of the GNU. I think we can safely say, as Gary said, the financials are under pressure because of the noise around the GNU, the currency, the yields are also pushing out. So what that does, it takes rate cuts off the table, puts inflation back on the agenda for South African, puts pressure on your retailers as well. Those will be other knock-on effects. So the only sort of somewhat safe haven at the moment is a pure play rand hedge. And that's not the miners, because the global economy growth is under pressure now because of these tariffs as well. So the commodities look a lot less attractive. So yeah, gold and maybe some of the, British American tobacco, these are safe places to park your cash, I think. But, the core principle always remains, over the long term, look for good companies. If you're getting a good company that's selling cheaper now than it did a year or 2 or 3 ago, you should be adding that to your portfolio. You don't have to buy it all today, but you should definitely start buying. We've been through many crises, and we've been through worse than the GNU breaking up. If you think of Nader and some of the drama we've had over the years. So I'm more of an optimistic person by nature. I think you should be looking through these things. The banks were already cheap coming into yesterday. They're significantly cheaper now, and maybe for good reason. But give it 3-4 years, and these will probably have been great buying opportunities.
Yeah, I had forgotten about Nader, which perfectly illustrates your point. I mean, at the time it was world-ending, except of course, here we are almost 10 years later. Gary, would you be adding gold at these levels?
Oh, that's a difficult question. You're the oracle of gold at the moment. So, looking at it, a difficult question. So, there's a huge tailwind to gold at the moment. So, originally it was, mainly the rally, through most of the lower 2000s was driven by central bank buying. So, we saw massive increases in purchases by central banks, and the investment community sometimes follows that momentum as well. So once we saw the gold price moving up more aggressively, then you suddenly see a spike in flows into ETFs and ETPs and all the different ways that you can hold gold. So, I don't think that the gold bull run is over. I think we're still in for a fair degree of uncertainty. I don't think we've seen the second round effects of tariffs yet. And gold is an inflation hedge as well. For South Africans, it's also a wonderful currency hedge. So there's a lot of arguments towards buying gold. I don't know if I would buy gold today. I mean, that we buy Krugerrands through the JSE for our clients, and we were in the market last week and the week before buying on behalf of clients. I mean, I think we're getting about a 7,000 rand discount per coin for them. So it was, I think someone just had left a persistent order in. So we were actually purchasing physical gold last week. But I don't know how far. Yeah, I don't know how far this can go. And I mean, we were kind of discussing it. The move from like let's call it 1,500 to 3,000, 100% move. I mean, that takes us to $6,000 gold price if we're going to get the repeat move. So I don't know. I think personally there's upside. I think it does belong in the portfolio, but yeah, it is a little bit difficult to buy now if you're not getting a discount.
Yeah, and I love that old-fashioned physical coins, which then have to be delivered to be settled. Grant, you mentioned retailers. Let's quickly touch on clothing retailers. Question coming through. I mean, Mr. Price is almost a third off from the highs of late last year. It certainly had got very expensive. To your earlier point that there's some quality out there and we can buy stocks at prices we haven't seen for a couple of years. Would clothing retailers be on that list? If yes, which would be your preferred?
They wouldn't be the first place I would shop.
Okay.
I prefer the staples at this point, simply because you don't know what the impact of the rand and the currency is on the outlook for inflation and discretionary spend. However, if I did have to buy a discretionary retailer, Mr. Price would be one of the top two that I would look at, and the other one would be Pepkor, which I think is doing a really good job of transforming that business and refocusing. So those would be my two.
Gary, in the minute before break, clothing retailers?
Yeah, I think maybe not quite as negative as Grant on clothing retailers. I think a mix between clothing and grocers is fine. I think the South African consumer is in a lot better position than people might realize. A lot of and I specifically like is PEPIC as well. A lot of the South African wage agreements have been the 5-year agreements, and we're in year one, maybe 2 or 3 of 6% increases. At the same time, our inflation is at 3.2%. So you're actually seeing real wage growth in South Africa. So the consumer that's been so under pressure is actually feeling a little bit of relief, even with at least high interest rates. So, yeah, I think we've obviously had a big sell-off in the retailers at the moment. They are starting to look attractive to me. I mean, I don't know if we're quite at the turning point yet, but a lot cheaper than they've been in a while, and I think worth having in portfolios, because I think there is a tailwind to this.
Gents, let's get to some more of the questions coming through. A question on Chrome is flying. I have to be honest, I don't track a Chrome price. Best way to get exposure to Chrome. Grant, is that not, I mean, the PGMs, it's a byproduct. I mean, we've also got Jubilee does a bit, Chrome.
Yeah, I would think, and I'm not close to it because it's such a small part of the PGMs, but I think Jubilee is one of the closest to a direct Chrome access. It's one of their bigger, I think it's 30% or whatever of their earnings. So that might be the way to play it. But I can't contribute much more than that on Chrome, thanks, unfortunately.
Me neither. Gary, are you a Chrome guru?
I definitely wouldn't say I'm a Chrome guru, but I believe Chrome prices have been moving up recently. But I mean, there's a lot of drivers to Chrome prices, and South Africa is a major international supplier. I think on Jubilee, I had to look at Jubilee quite recently. So, I mean, it is very Chrome focused. So if you look at the 2025 numbers, Chrome accounts for around 81% of revenue at the moment. So it's pretty concentrated in terms of Chrome. And I believe they are looking at expanding into Chrome as well. But again, you look at the Jubilee share price, and I would be very nervous because I think there's a lot of factors that drive underlying Chrome margins, and they can turn around on a dime, especially when we're in such an uncertain regulatory environment where you might suddenly have a huge tariff on your Chrome as well. So I would just be careful about expressing a view once the Chrome price has already run as hard as it has.
Yeah, and Jubilee's down 30% in the last 6 months.
Yeah.
I mean, it hasn't reflected the prices.
No, not at all. The shares had a tough time, and I was not aware the quantum.
Maybe there's a gap for you, Simon.
Let's go offshore. Question coming through. Amazon is looking cheap. They won't be too badly hit by tariffs, perhaps, because, of course, they don't manufacture anything. Gary, certainly I was looking at Amazon earlier in the week as well, and it is looking cheap. Would you be out there buying some Amazon or perhaps keeping a close eye on it?
Yeah, I would. Yeah, Amazon forms one of the core holdings in our global equity portfolio. It's looking at it from an international point of view. I mean, it's one of the real blue chip companies. It's an absolutely dominant in e-commerce across the globe. They've also obviously got the high margin AWS business, which I mean should maintain its advantage and kind of almost allow it to earn economic profit for many years to come. And then obviously with all Amazon Prime memberships. Kind of integrating their whole ecosystem. I mean, it's an awesome business. I think the risks around Amazon at the moment, and specifically, in the tariff environment is, these big companies, specifically in the EU, do face, significant regulatory concerns. It's very easy for the EU to legislate and punish firms like Amazon, and I think that could be an issue. But overall, Amazon, I mean, a quality company, and it has pulled back fairly recently, and I would say it should be in probably any international portfolio.
Grant, your take, they've also got, which I didn't realize, a giant advertising business. You can advertise on Amazon for your products. Grant, are you a fan of Amazon?
Yeah, we are. Yeah, it's definitely on the shopping list as it pulls back. It's as cheap on a forward-looking basis as it's been. You don't often get it as cheap. Bear in mind, it will be sensitive to retail spend in the US, consumer slowdown. So the price may still soften, but it's one of those you should just close your eyes and accumulate. That advertising business, I think, has still got a lot of legs, and that's really the current growth engine on the retail side. And then, of course, the cloud and AI piece is fantastic. So it's one of my favorite companies. I would definitely be nibbling on the way down. But they could still be going down, but that's okay.
Yeah, there could be lots more down, but I take your point. That's okay. Question coming through around Tsogo Sun. Surely should be offering some value. It was up at what, 13 odd rand late last year. It's now around 8.50 rand. Grant, Tsogo Sun. I mean, we've got a couple of. So we've got City Lodge, which is hotels. We've got Southern Sun, which is also a lot of gaming. Tsogo Sun, does it fit in your portfolio?
It doesn't. I think they've battled to navigate this move to hybrid online gambling, physical gambling. I think Sun International has done a much better job of that. Their portfolio seems a little bit skewed in terms of 1 or 2 stars, and then a couple of other properties that are not the best. So no, I don't love it. I think they've got some challenges, and I don't think things are improving enough in SA to materially improve that outlook. So I wouldn't be buying that one.
Gary, Tsogo Sun?
Yeah, not really one I look at. But I kind of agree with Grant. Like looking at what Sun International has done through Sunbet, I think they've made that digital transition really, really strongly. Whereas Tsogo, I think, maybe a little bit behind. I mean, they've got like obviously bet.co.za, but you do get the sense that Sun International may be a better quality business, but it's not one that we it doesn't really fit into our local equity strategy. So yeah, at the moment, we steering clear.
Gary, let's stay with you. Question coming through around Nike. Really like the stock. The turnaround is struggling. And of course, most of their products manufactured in Vietnam. I don't know what tariff Vietnam got, but I think if my memory serves, it was close to 50%. If you were holding Nike, would you be worried or would you be looking at this as an opportunity?
I think Nike's been a little bit of a difficult one for investors recently. It's kind of hit the skids, around, just their operations in China as well. And, it looked like an opportunity at about $75 and it's still sliding. So, I mean, it is a fantastic business. I mean, the brand is absolutely stellar, it's recognizable the world over. And having a powerful brand like that gives you the ability to create margin as well. But, I think I'm a little, I mean, it is a holding in our portfolios as well. But at this stage, with the uncertainty around tariffs, maybe holding off. But longer term, if you're looking 5 years out, probably can pick up at this stage. But they definitely want to see a catalyst for a turnaround, and I'm not seeing that at the moment, which is concerning.
Grant, Nike?
Yeah, I mean, I think this business will be okay longer term, but they need to do more on turning that business around. The new CEO is talking a good game. I
Yeah.
haven't yet seen the execution, and that's one of the concerns. The concern around Vietnam, I think that will be okay. I think they'll come to the table and appease the US because they just have to. And so that I think that will be some sort of relief, even though the stock's been sold off. But I do think they have some challenges in China. The anti-US sentiment's not going to go away. It's going to grow as this trade war escalates, and so that could pose a problem for them. So I'm mixed emotions about this one. I like the stock. I think it's got potential, but I'm not sure there's any rush to accumulate it further. Yeah.
Bringing it back home, question coming through around Datatec. We had a trading update, I think it was Thursday last week. Not a bad trading update. We don't have much of a tech space, although of course, if AI is what it's going to ultimately be and consume the world, Datatec, even with their switches, has a place. Grant, is Datatec one that you keep an eye on? I, to be honest, hadn't looked at it since about 140 Rand 25 years ago.
This is one of those I've had only half an eye on, and I've watched it go up the past 12, 18 months. They seem to have done a really good job of improving execution, operational efficiencies, spinning off some of the noise. And I think they've repurposed this business really well. I'm not close to it, I must be honest, but I think I've missed it. I think that was my mistake. I think they're doing a significantly better job now, and it probably does warrant a closer look.
That is a chart that I was not expecting to see pop up on screen. Gary, Datatec?
Yeah, it's one of those ones that just flies under the radar, and you don't think of it as a very well diversified rand hedge as well. So it's one of those companies. Yeah, it flies off the radar, but I mean, with the share price performance, it's hard to argue we shouldn't be looking at it a lot more closely. So looking at it in terms of earnings as well, I mean, it's not particularly expensive at about 12.5 times earnings, and if I look out to kind of growth forecasts, I mean, we're looking at probably like, I'd say 12%, maybe 17% growth over the next couple of years. Yeah, I think it's an interesting one at this stage, but yeah, you kind of look at that share price chart and you think maybe we've already missed it.
Yeah, although we come back in a year and we realize it was just warming up. That's the joys of investing. I need to go to stock picks quick before we do. Question on Blue Label. Gary, is Blue Label one close on yours?
No, also not one we look at, but I mean, amazing rally that we've seen in the stock price over the last little bit. So, but yeah, not one that I'm close to.
Grant, any deep insights on Blue Label, apart from the fact that they got Cell C and maybe they listed?
I would just say there were years of promises and missteps, and I think it turned off a lot of investors. I think for once they're actually getting their act together and they've streamlined that, and they seem to be getting it right. Yeah. But no, we don't have appetite for that one.
Yeah, I'm with you on that. So let's go to stock picks. Grant, there was a question coming through around Shoprite. Forward PE under 20, price around 250, has to offer value. You're concurring. It's your pick tonight.
Yeah, absolutely. And if you think about it, what is it going to give you? If we see rising inflation, which potentially is on the table, looking at the rand and the like, if we see slowdown in growth, Shoprite is a defensive. It's people have to eat. They have to buy the staples, the basics. So you're still going to see that safety in that company at a decent price. Plus, if things improve, they're still going to grow. So I think it's a nice way to gain exposure in a sort of a more balanced fashion. We know that it's a lower risk entry into the market relative to, say, a discretionary, where the timing probably matters more. So Shoprite remains high quality, defensive, and a good growth vector as well. So I'm happy to own Shoprite at these levels.
Gary, index auto call, structured products. Give us the details.
Yeah, so we looked at it. So essentially, these are products that give you a level of capital protection. We've put in 30% capital protection on this product. It's linked to the performance of the S&P 500, the Nikkei, and the Euro Stoxx, so big, broad indices. If all of those are positive on the observation dates, which are semi-annually starting after 1 year, you currently get, it's around a 14% US dollar coupon. And we've been pricing that. And one of the reasons we normally get kind of between 12 and 14%. And I think we might get a lift on execution on it as well. One of the reasons for that is, one, we're in higher volatility, so that's the one reason that we get a higher coupon, and also yields have risen at the kind of the long end of the curve as well. So that's also kind of boosting the return. So a lot of clients, I think, after the last 2 years have forgotten that they kind of expect the S&P 500 and the markets to do around 30% a year. The long run average is only around 9%. So if you can build in a bit of capital protection for a client in a product, link them to upside, as long as the thing is positive, at some point over the next 5 years, and these three indices are positive, you're going to get a well above average dollar-based return, fully offshore product. So we like it in times of uncertainty like this. We're also setting the index levels a little bit lower because we've had these indices come off. And with the kind of added fear in the market, we're getting a higher coupon. So it looks like a good time to put it in. And if markets are flat and if the world really does fall apart, like everyone seems to be predicting at the moment, and you only have a flat return over the next 5 years, well, you'll get literally a simple interest coupon of around 14%, which I think is pretty cool.
Okay, no, pretty cool indeed. We'll leave that there for this evening or for Stockwatch. Thanks to our guest, Gary Booysen, going with an index auto call. Grant Nader from Benguela Global Fund Managers, going with ShopRite. Up next, the close. Stay watching.